I want you to think of this when you're building your 529 investment portfolio, and that is, are you taking on enough investment risk? Now, I'm not telling you that you should take on more risk than you're comfortable with, but I'm hoping that through this video, you're going to be more comfortable taking on more risk. And why this makes so much sense? Because you want to work smarter, not harder, right? That's the name of the game. And I think that there's just so many portfolios out there in the 529 college savings plan space, like these target date funds, these prepaid plans. They sound good in theory, but I just think that they're too conservative. And when you crunch the numbers, you're going to have to save significantly more. And you really have a lot of goals that you're trying to balance. You have retirement, you have just the fact that you want to build wealth, and of course, in this case, you want to send your kid to college. So let's work a little bit smarter, not harder. So let's talk about an S&P 500 fund that you can invest into. I'm going to use the Vanguard fund, and we're just going to use that as an example, and we're going to compare it to the prepaid plan, kind of on the other side of the spectrum. Those prepaid plans are guaranteed plans, so they're really the most conservative plans, but right next to them are these target date funds. Even the aggressive ones are a little too conservative for me, so I'm going to explain that as well. So let's go ahead and bring up this fund on the screen and go through this together. So here's the 529 portfolio, the Vanguard 500 index portfolio that basically tracks the S&P 500. And if you're worried about diversification, just to give you a little insight, the S&P 500 captures 80% of market capitalization. That is the share price times the amount of shares outstanding. So think of that as a pizza pie. Each slice is a share, and the whole pie would be the value of the company. Now think of that from all companies in the US, 80% of those 80% of the market capitalization, the sizing of these companies, 80% are in the S&P 500. So diversification, you're getting diversification in a single fund. So let's go ahead and take a look at this. So here on the left, we have the annual returns of this particular S&P 500 fund from Vanguard. And on the right, for the benchmark, that is the S&P 500. So if you look at each one of these numbers going across by year, they look almost identical, but the ones on the left are a little bit less, and that's because of the fees that Vanguard charges. So basically, it's tracking the S&P 500. So we're going to use this fund, okay? And I put it into a Google sheet. And I want to point this out really quickly. If you're looking for the average, what you want to look at is the compound annual rate of return. Here's the difference. The average of these numbers, of this return of this portfolio, would be 12.24%. But that is not considering compounding. Averages don't consider compounding. So that's why you really want to look at the compound annual rates of return. That is what you want to take a look at. So if we do this math, it's going to work out to 9.5% compound annual rate of return. So here's the example that I want to go over. So I compared this in a previous video, and if you haven't seen it, you can go see it, or I'm just going to go through the numbers right here. But we're saving $185.82 per month for 18 years. And according to this example, which is one of those prepaid plans, this one happens to be the Florida prepaid plan. And again, this is the more conservative options, or the most conservative. That is going to give you a benefit of $63,500, or that's what they're estimating. So this is how you can figure out this math. So that works out to 4.79% annualized compound rate of return, okay? If we get an 8% investing this 185 for 18 years, that would equal 89,000. If we got 9%, that would be 99,000, 10% over 111,000. And I just told you that the S&P 500 over that same time frame that we just looked at was at 9.5%. So I have that math already written down right here, and that works out to $105,432. This is what the performance is if we invested in the S&P 500. That is significantly more than this $63,500. Again, you know, historical numbers are not indicative of future returns. They're not a guarantee of future returns. But you gotta, you got to put some numbers in there. You have to have some idea of where we're going to head. So I believe that it's pretty reasonable to think that you can get an 8 or a 9% and possibly even a 10% rate of return over the long haul. You just have to be able to handle this volatility. Now, a 9.5% compound annual return, let me go back and show you something that you might have missed if you didn't catch it the first time. And that is, if we look at this right here, we included 2008, negative 37%. And still ended with a 9.5% compound annual rate of return from 2007 until 2021. So let's take that number from 2008, negative 37%. Let's take this number right here, this 105,432, and let's say you had this amount right before your kid was going to go to school, and you got a negative 37% rate of return. I already did the math for you, so that's going to bring it down to $72,403. $72,403. $72,000 is still more, significantly more, than the $63,500 that you would have had if you used the most conservative option. And as you get closer to going to school, yeah, you can reduce your risk at that point. But in the early years, taking on less risk is just going to mean you're going to have to either save more, get financing, take out a student loan, or just make other arrangements. And it's just going to be more difficult. That's not working smarter. That is working harder for the same goal. Now, again, I'm not telling you to take on more risk than you're comfortable with. I just want you to understand how investments work. And that was including a negative 37% rate of return twice. Is the numbers I just showed you. We had that twice, and we still were ahead of a prepaid plan. Now, there are other options out there. You could take a look at some of these target date portfolios, but look at this. I mean, this is a target date portfolio of 2040, 2041. That is somebody that's born, if your kid is born today, this is what this portfolio is for. And that just seems ridiculous to even have 5% in bonds. And to think that bonds are somehow immune to market forces, that like they don't go down, just add more bonds and somehow you're magically more conservative, it's just not reality. So if we take a look at some of these funds, if we look at this S&P 500 or the S&P website, they have a whole bunch of different indices. Take a look at this U.S. Aggregate Bond Index. Right here, year to date, we're down 8.55%. So compared to the S&P 500, which is down 12.5% or right around there, yeah, the bond index lost a little bit less year to date. But if we look at these numbers over longer periods of time, this bond index from 2007 to 2021 right here at 4.5%. So that number is even lower than the prepaid target numbers that I just showed you. So why even would you put 5% day one into your portfolio? Because it's more diversified, more conservative? That doesn't make any sense when your time horizon is 18 plus years. And even as we get closer, 10 years, 5 years away, it just doesn't make a whole lot of sense to keep these bonds until you get really close or at the time that your child is going to go to college. Now, again, I've shown you what happens if we put it into the S&P 500 and you have 2 massive down years, you're still ahead of these more conservative options. So I don't know if it makes a whole lot of sense, even though it looks like the easy button with these target date portfolios or the prepaid plans. I don't think it's the right way, especially when you have so many goals, so many things on your plate. It's about working smarter, not harder. So let me know what you think in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.